Hello everyone, and thanks very much for joining us. My name is Shannon Manders, and I'm the editorial director at GTR, Global Trade Review. Now it's the start of a new year, so we thought we would team up with the folks at Taulia to talk about what we expect to be the most important trends and challenges for CFOs over the course of this year. Joining me in this discussion, we have three fantastic speakers. We have Marina Goldberg. Marina is the Senior Director of Product Management at SAP. Alongside her is Alistair Baxter. Alistair's Head of Receivables Finance at Taulia. And alongside me, Oren Bass. Oren is Head of Origination at Pemberton. Thank you very much for joining me. Now, Oren, beginning with you, let's get right to it. What factor would you say is likely to have the biggest impact on how CFOs operate during the course of this year?
Thanks. Yeah, I mean, clearly it's going to be a difficult time, right? I think inflation is here to stay for at least a while. It's not as transient as some of the central bankers were hoping initially. CFOs are then, and big corporates are battling higher input costs, higher borrowing costs, and lower revenues. So this combination really is a difficult environment to navigate. In light of that, I think access to capital is going to be an absolutely key focus for CFOs, and finding efficiencies in their business and where to be more, conscious of spending is going to be really paramount. And I think access to banking capital is also going to be, I think, increasingly more difficult. Banks are retrenching, they're taking off risk, and I think seeking alternative sources of capital, such as where Pemberton steps in and plays a role, I think that's going to be incredibly important for CFOs as well.
And if you had to make, say, a prediction in terms of how big businesses may alter their behavior as a consequence of inflation throughout the year?
Well, I think we've gone from a period of the last 10 years with an abundance of capital, very low rates, to a period which encouraged growth, to now a period of retrenchment and conservatism. I think people can be more cautious. I think it'll be defensive in corporates, and that means that I think a lot of companies who aren't necessarily in a strong position are gonna suffer. And there's certain levers that I think CFOs can pull on to really play that defensive card. And I think that goes from finding efficiencies in their operations, and you're seeing a lot of layoffs in the market now. That's one form of trying to find operational efficiency. Other companies can look to pass on the increasing input costs to customers. But of course, some can, some can't, depending on the strength of the company and the sector. And I think some other companies will look, and we're going to touch on that later, I believe, to improve their working capital cycles and their cash management. Mm-hmm. And I think that's where innovative and tailor-made type of working capital solutions are really important, and will play a very key part in improving that cycle and improving the efficiency of the businesses.
Thanks, Oren. Alistair, obviously a really challenging environment. Is it hard to look past inflation as the sort of key main concern for CFOs this year?
Yeah, so I guess if inflation was the number one concern in 2022, recession is fast becoming the concern on a CFO's desk this year. And not just at large corporate levels, particularly in the kind of small and mid-sized businesses. Being able to accelerate cash is going to be absolutely paramount, both to the survival in some cases of businesses, but also to support real economic activity at the ground level. And as we get closer to a downturn really biting, following through all the indicators, this is something we're seeing more and more. So, for example, over 50% of small and mid-sized companies in the G7 have already started to tap up external sources of funding. So we're seeing a big shift in credit markets away from where companies were previously cash funding themselves to a place where they're starting to rely more upon their financiers and their trade to support the business through this tough time. So in addition to that, the situation's only going to get worse for small and mid-sized companies as we go through the recession. They've already built up substantial levels of debt, and as rates continue to rise, that's only going to put pressure on operating metrics, reducing cash flow, and really putting working capital under a great deal of pressure. And indeed, we're already seeing businesses react to that. Some research done recently shows that over 60% of businesses are looking to put in place a working capital management strategy this year. Previously, working capital was a little bit lower on a CFO's priority list, but in light of all the challenges we've seen over the last 12 months and looking into the next 12 months, this is now becoming a real hot topic. And having the tools available and the financing available to stay through this period is going to be of paramount importance to all companies, but especially small and mid-sized ones.
Marina, so we've heard about inflation, we've heard about the recession. In your mind, what is going to be the most important impact that influences CFOs this year?
Of course, at times of inflation and coming a recession as well, Oren was saying, yes, CFOs will adopt a more defensive position and will be looking for those levers to try to react to the situation. I would say this has a lot to do with how well integrated your systems are so that they can give you an accurate view of the situation and how well prepared you are to actually act. Do you have those levers at your fingertips? Of course, the ability to optimize the cash conversion cycle is going to be key. The more insight to action type of tools you have, the more real-time reporting you're able to get out of your systems, the better equipped you are to face the situation and to react. For instance, the ability to simulate the impact of rising prices on a raw material that's key in your production will greatly help you face that situation and react to such scenarios. Last but not least, inflation is a systemic phenomenon, so it would affect your business as much as it will affect your customers and your suppliers. That's where integrated collaborative systems such as the Business Network and Taulia integrated into it, offering financing opportunities for suppliers, can tremendously help make businesses more resilient in that circumstance.
So we've talked about the need to have transparency and to simplify these processes, but how do companies actually go about doing that?
I would say there are 4 key parameters that a CFO can look into. First of all, would be digitize those processes. Obviously, going for the digitization is an opportunity to review the process, how we operate today, what can be improved, where are those inefficiencies. So it's an opportunity in itself to just start it off. And according to a 2022 US Pulse survey, more than 50% of finance executives are looking to put in place this kind of digitization of processes. The second would be, there are companies out there in the tech sector that have already invested a lot in analyzing these processes, such as how do you optimize your spend, to bring it to the essence of what this has to deliver. And I would recommend highly that people follow those standardized processes, because this is how you get to efficiencies. If you start, following your specifics, you reduce the time to value. So you have more time to value. You bring in complexity that you're gonna pay for later on. So the more you adhere to the standard processes, the better chances you have to get more value out of it. The third area would be go for cloud as much as you can, because that's where you get the innovation as fast as possible, and that's where you leverage all those new things as quickly as possible. And my last recommendation would be choose a partner that really knows your industry, because that's also key. If you're looking to take into account your specifics, that may be important.
Now, digital acceleration was it has been a key trend over the last couple of years, really kind of driven by the pandemic. But Alistair, in your mind, what are your thoughts on the transformation of CFOs' digital roadmaps, bearing in mind what Marina has outlined for us?
Some really good points there. And I think that we're seeing that reflected in our day-to-day conversations with the C-suite of our clients and prospects. And there's a few points that keep coming up again and again. And I think it's key to understand the changing role of a CFO as well. It's no longer just a case of making sure the books are square, but there's much more of a vision and strategy that is deeply embedded in leveraging data to achieve corporate goals. And I think that's the first point, in that a lot of companies are sitting on a huge amount of transactional data, and the companies that will succeed and trade through this difficult period and find growth beyond are the companies that can best leverage and manage those data sets to support their customers, to exploit new markets and find ways to grow. And that in turn requires a skill set to support it that businesses are going to have to grow organically or recruit externally. So being able to leverage data science, algorithmic learning, even artificial intelligence to find ways to kind of push their business forward is something that's going to be almost the single most important thing that sits on a CFO's agenda when trying to empower the financial supply chain behind the physical supply chain that makes their company work. And ultimately, that's where the world is moving to. And the companies that jump on that the quickest are the ones that will find success fastest.
Oren, would you say then that the digital transformation is here to stay?
Yeah, definitely. I mean, I think it's been a hot topic for a while. I think most big corporates have been undergoing extensive digital types of programs or I guess renovations, shall we say. I think now is into a more challenging environment, obviously with less free cash flow as a result of higher borrowing costs. I think investment in digitalization will probably pull back a bit, and we'll really see kind of those people who've already invested and are continuing to invest, the benefits hopefully start to reap, or they'll be able to take advantage of all the work they've done. But I think the point we're touching on here that both Alistair and Marina talked about in terms of data is really important, because when you look at it from a financing perspective, to really understand where a company is at any given point in time, it's a data question. And for us to be able to, as lenders, provide the right type of financing at the right price, I think understanding that, the cash flow cycle, where they are in terms of how much, receivables they have coming in, what payables they have at any given time, really comes down to the same core question is a data challenge. So I think the better the systems, the better the transparency, and hopefully the better pricing.
Great. So we're touching on all the hot topics today. Alistair, what other factors do you think are going to impact the way that CFOs do business this year?
So I think fixing supply chains is going to be of paramount importance. The reality is that today the world is a less global place than it was 12 months ago. So the surgical redesign of supply chains is going to be something that CFOs have to have at the top of their agenda, so that they can leverage the data, they can understand the value chains that support the supply chains, and ultimately deliver to their customers in a way that enables their business to survive and find growth. We actually undertook some proprietary research as part of SAP with Coleman Parks, and that's showing that organizations do believe that their supply chains need improving. All companies unanimously came back saying this has to happen. And 2/3 of businesses, they are already moving away from a just-in-time to a just-in-case model. So as we see companies redesign supply chains to move perhaps away from autocratic jurisdictions, perhaps find ways of limiting exposure on scarce supply routes through container shortages, for example, we're seeing things change, and being able to optimize that across a broad spectrum of data points is super important. We're also seeing, linked to that, 58% of businesses think that global political unrest is the main factor. So to be really clear, there's a single issue that's having a massive impact across global supply chains, and businesses are unanimous in saying that's the single biggest pain that they're facing. Looking forward, we expect disruptions to continue in supply chains, especially when we start looking at things like reduced availability of raw materials, slowdown in the US, particularly around about the building of new homes. We're a very real estate anchored set of Western economies. So things like this will have a major impact beyond just the construction sector. So these are things that need to be factored in.
Oren, would you agree with that? And are you seeing any sort of changes in the types of financing that is required as a result of these challenges?
Yeah, definitely. Kind of the move in terms of just in time to just in case, and the build-up of inventories in a rising price environment, I think necessitates capital, right? So we've seen a lot of companies across the spectrum looking to ask for inventory financing, so they can lock in the price now and benefit from that rising price environment. And that that has all kinds of complications. I think it's an area that banks can't necessarily play in because of the regulatory reasons. But definitely, I think as people start to understand the environment in which they operate now, and these corporates are starting to see that, they need to have the financial solutions to equip them and to protect them. So yeah, we're definitely seeing that.
Supply chain resilience has been such a buzzword over the last couple of years. But how exactly are CFOs going to ensure that they drive that resilience into their supply chains this year, Alistair?
A healthy supply chain requires not only the physical infrastructure and human capital to deliver physical products, but also the smooth flow of capital up and down the supply chain. And what we're finding is that the government regulations quite often limit the use of trade credit to achieve that goal. So we're quite a stretch away from where we want to be. Instead, we believe that a market-based approach that uses technology to deliver capital at the points in the supply chain where it adds the most value is going to be the single biggest needle mover this year to open up supply chains and trade through a very difficult period. One example is the Asian Development Bank has done some research, and they believe that the trade gap facing small and mid-sized companies is $1.7 trillion. So this is a monumental problem for small and mid-sized companies to overcome, and unlocking that gap and allowing capital to flow where it's needed is going to be absolutely crucial. And ultimately, that gap exists because of a lack of collateral, information asymmetry, and essentially understanding who is trading with whom and how we can build trust in that to allow capital to flow. So digital technologies are going to be key to closing that gap and allowing the funds to flow.
We'll come on to digital in a second, but Oren, Alistair's raised the point that this gap exists. How do we go about bridging it?
We've absolutely seen that. I mean, that's kind of a lot of the thesis for kind of why Pemberton's launched the working capital finance strategy, is that the sophisticated working capital or supply chain finance techniques are really only available to large corporates. And there's that sub-investment grade and all the way down to SMEs that could really benefit from these types of financing structures, but they're just not accessible. We're trying to roll out where the banks typically aren't playing, and we've focused more on the sub-investment grades versus SMEs. However, what this allows these companies to do is to pay their key suppliers earlier, build up needed inventories to take advantage of this inflation environment in which we're in, or receive payments for services or products faster. Mm-hmm. So I think this gap is really going to be addressed by new types of lenders, direct lenders stepping into the place where the traditional banks aren't playing.
And it's also going to be bridged potentially by data and technology, right, Marina?
Actually, today with the technology we have, like collaborative portals such as the SAP Business Network, we can already operate supply chains and gain visibility into their efficiencies and associated risks. We can also deploy financial and ESG programs as well. We didn't talk a lot about sustainability, but it's definitely a point here, and associating lending where it can encourage suppliers to be on the sustainability track is something extremely valuable, and I believe talks to every CFO today. While the tools exist and continue to evolve, we also see some sort of shift in mentality at the CFO office, where the supply chain is no longer considered as just a set of businesses out there. No business does business alone, right? So you need to really take care of that ecosystem of business partners, and the ability to put in place such financing programs is an efficient way to support during these difficult times. That's exactly what we are doing with this end-to-end integration from the corporate's back end to the collaborative portal, and then ultimately to the supplier. We have a very efficient, automated way of executing on these financing programs. And when it comes to data, Oren, you mentioned about data and the value of data. It's not so easy actually to go and get the value from data, because the data can be in different systems. The quality is not always there. So a system that can aggregate and deliver, make the data talk, the language that you need to hear, that's really something that SAP is also heavily investing in.
Now, we've touched on some really massive themes throughout the course of our discussion, but are there any additional predictions or key areas of focus for this year that you think are going to be really important to CFOs as they take on 2023?
I think in times of stress and retrenchment, I think that presents opportunities. And so I think companies who have access to capital, access to cash, who can unlock cash through optimization of their working capital cycles, I think that will present amazing opportunities to either strengthen their market position, take advantage of weaker competitors in the market, and maybe even we're seeing a pullback in M&A, but I think there will be some elements in the market where there will be a consolidation, because some companies will struggle and other companies will be able to step in and consolidate. So I think access to capital, access to cash through the techniques we've spoken about, through access to different type of lenders such as ourselves, I think that's really going to be a key determining factor of who wins and who loses coming out of this.
Marina?
There could be trends. I would have a few months ago, but today I would focus on embedded financing as a trend. I think we'll see more and more of this, financing type of offers embedded in processes or products that are non-financial. To take one example, in the procurement space, for instance, a virtual card on a purchase order would be one of those. So yeah, I think there is a lot to come on that front in this year.
Alistair?
I'll maybe take two, if I may.
Sure.
So I think that the first one is going to be disclosure. We've already seen FASB come out with a new set of rules. Previously, companies would disclose voluntarily their position on supply chain financing. That's become more regimented. So there's going to be a lot of redesigning and consideration amongst C-suites as to how they play that. IASB is not too far behind either. So that's going to be something that's going to be a big talking point. But in addition to that, my kind of second point is that my prediction is 2023 will be the year that ESG goes big. Historically, coming up with an ESG rating or splitting out the ES and G individually on a particular company has been quite widely adopted. We've seen green bonds and a lot of activity there. Magnifying that through a supply chain, so working with suppliers who also adhere to your ESG standards is in some ways the fiduciary duty placed upon corporates who are trying to lead the way and take us from the world that we are in today to the world of the future.
Well, thanks, guys. I think that's been a really insightful discussion, and hopefully that shines a light on sort of what to expect and how to tackle the year ahead. So thanks, Marina, Alistair, and Oren, and thanks to you all for tuning in.